few years ago, we wrote a newsletter called Cash Flow is King, and we're just about to update it. We're a big fan of cash flow in a portfolio. So what we have is, remember these three asset classes we talked about, the ones that are challenged? Well, the first one is fixed income. And in fixed income, really what you're doing is lending money to people and they're paying you interest. So that's cash flow, the interest. And in real estate, you're getting rental income. So that's also cash flow. And in equities, public or private, you're entitled to a share of the profit in the form of dividends, which is also cash flow. So the objective is how much cash flow is being generated in your portfolio. Most people have no idea. Like if you look at your statement that comes in every month, you look at the statement and say, maybe you had a good year last year, you made 7%. How much of that was cash flow and how much of that was just the price of things going up? Most people have no idea. Why is it important? Because cash flow is 3 to 4 times as volatile as cash flow. So when the stock market dropped 45% in 2008, dividends only dropped 12%. Rents didn't drop at all. And so in other words, if I want to predict something, I can predict cash flow. I can't predict price, but I can predict cash flow. And that makes a difference. So you need to know how much cash is being generated on an ongoing basis in your portfolio. So let's just look at this couple. This is a theoretical couple of ours, Bob and Linda. They're 60, good health, they want to retire. He's a lawyer, she's a dentist. They're both incorporated. They have $2 million each in savings. Bob's portfolio is he's not listening to us, so he's in the Morningstar's Balanced Index Fund. And his wife is listening to us, and she's in our core model portfolio, which is our asset allocation model. And they want to know what the impact would be if they take 4% a year out of the portfolio. So what we've done is pretended they retired in 2000, almost 20 years ago. So this is what happens. So remember, each of them are starting with the same amount of money, $2 million. And they're taking the same amount of money out. They're taking out 4% a year, indexed, so that's $1.8 million for Bob and $1.8 million for Linda. Now Bob is starting to eat into his capital. Not terribly, you know, after 17, 18, 19 years, he's still got $1.8 million. But Linda has $3.7 million. That's the difference between having cash flow and not having cash flow. So Bob's index income was greater than his overall return, obviously. 85% of Linda's return came from cash flow, which means even in the tough years like 2008, she didn't really need to sell a lot of assets in order to meet her 4% income goal. There was enough income being generated on the portfolio to meet it. When you take out money on a regular basis and you have a volatile market, so if you think about it, if you're taking out $100,000 a year out of a portfolio and the market's dropped 20%, you have to sell 20% more securities to get the $100,000. So you're automatically kind of, it's a bit of a wealth-destroying strategy. Bob has 6 losing years out of 19 with a combined loss of 28%. She has 2 years with a combined loss of 7. So the idea is to get rid of the volatility. So that sort of brings us to a conclusion. First off, my view of populism and the connected issues related to it is it's real and it's secular and we're going to see it for a long time. It's going to be part of politics for a long time. I do think that there's going to be a pretty bumpy road ahead in all asset classes. There has to be a lot more value add in a portfolio to weather the outcomes that I see. Behaving well would be one of them, paying attention to what you've done, but recognizing we've been here before. We've seen clients go through 2 significant stock market corrections in the last 20 years of more than 40% each, and so they've done well and they've performed admirably in that period of time. So I'm not terribly worried about the fact that markets might drop. I might leave you with just this one last thought, which is the following, that most of you are either building wealth for retirement or you've already accumulated enough wealth for retirement, which means almost all of you are likely to see your net worth increase as you get older, which means you are a net buyer of assets for the rest of your life. So when you are always the buyer and not the seller, you don't actually want the price of it to keep going up since you're still buying, if you think about it. Once in a while, it's nice when the oranges are on sale. Okay, you can get a little bit of a bargain. So the fact if markets correct 20 or 30 or 40%, that actually is not only a reason to not get depressed, it's a reason to break out the champagne. You have an opportunity to buy something that's considerably cheaper than it was 1 or 2 or 3 years before. Something to think about.